Open any financial news app right now, and you will see the same narrative. World War III is imminent, the Strait of Hormuz is permanently closed, and global crude is barreling toward $150 a barrel. But the price action tells a different story. In the second week of May, Brent crude dropped 5% in a single session, sliding back down to test the $90 support level. That reversal happened because the market is reacting to reporting from Axios and Al Arabiya, which confirmed that Washington and Tehran are close to a 14-point Memorandum of Understanding to end the war. While retail investors are often the last to react to geopolitical shifts, the data suggests that institutional traders are already shifting their portfolios to account for a sudden return of global supply. By the first week of May, Goldman Sachs had already trimmed its oil price forecasts, citing the impact of these ceasefire negotiations on global production. For the past few months, the market was buffered by strategic reserve releases and loaded tankers already in transit. Those buffers are nearly exhausted, which makes prices hypersensitive to the actual resumption of output. If this diplomatic breakthrough holds, exactly how much oil is about to return to the global economy, and where should capital rotate to front-run the market? This map illustrates the stakes of the 14-point deal. It is a phased de-escalation designed to reopen the Strait of Hormuz, clear a path for 20% of the world's total oil supply, and restore global shipping traffic. U.S. envoys Steve Witkoff and Jared Kushner are pushing this deal in Islamabad and Geneva to finalize terms and prevent a prolonged global supply shock. In exchange for lifting the naval blockade, the draft agreement requires Tehran to commit to a moratorium on uranium enrichment at its domestic facilities. The diplomatic hurdles are significant, but the market consequence is singular. Signing this memo would release millions of trapped barrels back into the global economy. The second shock to the market is structural. On April 28th, the United Arab Emirates unexpectedly announced its withdrawal from OPEC to become a free agent in the global market. Abu Dhabi invested heavily to reach a capacity of 4.85 million barrels daily, yet OPEC quotas restricted them to 3.1 million. By exiting the cartel, the UAE instantly increases market share once the strait reopens, unconstrained by previous limits. While supply is set to increase, demand is facing a long-term decline. The European Commission has launched Accelerate EU, a $711 billion investment plan to electrify the continent and break its reliance on imported fossil fuels. A peace deal unblocks the strait, the UAE is free to pump at its limit, and Europe is destroying its own fossil fuel demand. These facts suggest that oil prices are entering a sustained period of downward pressure. For an investor, the goal isn't just to watch the news, it is to identify how these shifting costs affect corporate profit margins. When the cost of crude oil falls, we look for sectors that possess an inverse relationship with energy prices. This correlation chart shows the opportunity. As the price of crude is falling, the profit margins for transport and logistics firms begin to expand. Their primary operating expense is vanishing. This margin expansion is the driver of stock price appreciation for the next quarter. This indicates a clear rotation into three specific sectors: airlines, shipping logistics, and consumer staples. Because fuel is a dominant operating expense for these companies, lower prices create a direct economic tailwind. This is particularly visible in oil importing nations like the Philippines, where lower energy costs feed directly into manufacturing and transport profits. Are you rotating into airlines and consumer stocks to catch this margin shift? Or do you believe this peace deal will fall through? Let me know in the comments. Subscribe for more.